Most traders think that their problem is the market, but actually it isn't. The market is not sitting there with some personal vendetta against retail traders. What actually happens is much simpler. Most people arrive in trading with the wrong mental model, the wrong expectations, and no real process for dealing with uncertainty. So they do what looks sensible in the moment, but destructive over time. They take too much risk, they change systems too quickly, and they confuse excitement with real edge, and they judge everything based on a handful of recent trades, and that combination is lethal. So in this video, I want to give you a different way to think about why retail traders fail. Not as a list of bad habits, but as a failure to build an actual edge from. Because that's really the dividing line in this business. It's not about intelligence, it's not about confidence, not even the level of effort. It's whether you've built something robust enough to survive real market conditions. And if there's one thing I've learned, it's that most traders are not losing because they're lazy or because they haven't put in enough effort. The first problem is that most people never define what success actually looks like. They say they want to be profitable, but what they really mean is that they want trading to work very quickly. They want proof early. They want their equity curve to go up in a straight line immediately. They want reassurances that they've found the real I am. But markets don't hand out confidence in that way. In the beginning, trading is mostly confusion. It's learning to deal with incomplete information, probabilities, drawdown, and uncertainty. And that means your early job is not to make a fortune. Your early job is to stay solvent long enough to learn. And that's a very different target. And once you understand that, you stop behaving differently. You stop asking, how much can I make this month? And how do I avoid doing something stupid enough to take me out of the game? And that leads to the second issue. Most traders don't respect survival. They think risk management is the boring bit, something to think about later once they've found a great setup. But risk management isn't a side dish. It's the actual strategy itself. If your position sizing is reckless, if your losses are too large, if one bad week can wreck months of progress, then it doesn't matter how clever your entry signal is. You don't have a trading plan. You have a fragility problem. The traders who last tend to understand one thing very clearly, that your capital is your inventory. If you damage your inventory too badly, you lose the ability to operate and stay in the game. And that's why professionals are often less obsessed with the upside than beginners expect. They're thinking about their exposure, their downside, the streaks of losses, or whether their system can survive a bad stretch without breaking the trader psychologically. And the third issue is that most people never gather enough evidence to know whether their approach actually works. They switch way too early. The strategy has a rough patch and they panic, they abandon it, and then they move on to something else that currently looks smarter. And this happens constantly. People don't just chase returns, they chase recent comfort. They move towards whatever strategy has looked easiest over the last few months. But real edges rarely feel comfortable all of the time. Momentum can whipsaw, mean reversion can keep buying into weakness before snapbacks come, and trend following can be slow and frustrating in sideways markets. But we've got to remember that doesn't mean the systems are broken. It means that every strategy has a cost. If you never pay that cost, you never have access to the actual edge it can provide. And that's where a lot of traders become stuck. They want a system without discomfort, without drawdown, without doubt. But unfortunately that system just doesn't exist. What exists is a set of trade-offs that you need to fully understand. And successful and profitable traders are usually the ones that understand their chosen trade-offs better than everyone else. Another big problem is that people think execution is a small detail. It isn't. Execution is the whole game. A strategy on paper is one thing, but a strategy executed by a human being who has fear, who has an ego, who is impatient, and has a phone full of distractions is something entirely different. You can have a perfectly decent system and still get poor results because you keep overriding it. You hesitate on entries, you cut winners far too early, you widen stops when you shouldn't, and you take trades that were never part of the plan because you're bored or frustrated of trying to make yesterday's losses back. That gap between the plan and the execution is where a lot of accounts quietly die. And this is one of the reasons why I prefer systematic frameworks. Not because they eliminate emotion completely, but because they reduce the number of decisions I have to make in a heightened emotional state. Rules create distance. Distance creates consistency. And consistency is the only way to discover whether you actually have an edge. The next issue is that many traders are not running an actual process, they're running a stream of opinions. That sounds harsh, but it's true. They have opinions, they have feelings, they have market takes of their own, but they don't have structured review, they don't have proper journaling, and they don't have enough data on their own behavior, so they never actually improve, because improvement requires feedback. You need to know what kind of setups you're actually taking, what conditions suit your strategy, where did you deviate from the rules, what kind of losses are acceptable within your system, and which ones are self-inflicted. Because without that, you're not refining your craft, you're just accumulating experiences, and an experience on its own is overrated. If you repeat the same emotional mistakes for 3 years, that's not 3 years of development, that's 1 year repeated 3 times. So what do the better traders do differently? Usually they simplify. They stop trying to be brilliant and they start trying to be repeatable. They choose an approach that suits their temperament. They define risk before return. They measure performance over a meaningful sample size. They accept the drawdowns as being part of the business, and they focus less on looking clever trade to trade and more on becoming statistically sound over time. And that's a completely different mindset. It's less exciting, it's less social media friendly, but it's far more durable. Because in the end, trading is not a game of being right occasionally. It's a game of building something that can survive uncertainty and still function well enough for the numbers to work in your favor over time. That's what an edge really is. It's not a magic indicator. It's not a secret setup. It's not some Discord group. An edge is a repeatable process with sensible risk executed consistently over a large enough sample size for the probabilities to really matter. And most traders never get there because they never slow down enough to build that foundation properly. And if you can do that, you're immediately separating yourself from a huge part of the crowd. And it's never because success becomes easy, but because your behavior finally starts to line up with how the game actually works.